Good morning or good afternoon, depending on what side of the country you're coming from. Thank you for joining us here for the 2025 Mid-Year Economic Update. Extremely hard to believe we've made it through almost 6 months, 5 months, 10 days here on June 10th. So really excited to go through a bunch of things today. Couple things here. I'm Charlie McQueen, president of McQueen Financial Advisors. I'm really excited because we have one of our leaders here with me today, but we do have our three main areas. We have our investment advisory services, which is standard and alternative portfolios, and Zach Whaley's joining me, who runs our alternative portfolios. We also have our asset liability management division and also our valuation teams. So really excited. I get to work with three different groups of incredible individuals, and Zach here joining me. I'm excited to have you here, Zach. Thank you very much for joining.
Charlie, what a fun time and what a fun topic. Can't wait to get into it.
Yeah. And it's here we are in Michigan, a beautiful day of June. It's 68 degrees and cloudy from the Canadian wildfires, so all things are normal, but really excited. So thank you, Zach. Next slide here. One thing, right before we get into trade and tariffs, just to do a quick stop. This is being recorded. If you'd like a copy of it, please reach out to your advisor and or go to our YouTube page. You get a copy of it. Also, along the way, if you have any questions, please click on the Q&A button on the bottom of the screen. That'll pop up. I'll ask Zach those questions along the way or at the end, whatever is most appropriate. So with that, Zach, please take off and let's talk about the one thing that's changes every 4 minutes.
Yeah, Charlie, I was going to say, depending on who you ask, the economy is either it's never been better, it's the best time of all, or tomorrow where everything's going to fall apart. So, I think the answer is somewhere in the middle, and trade and tariffs is a good place to start because exactly each tweet is going to change things. But this is where we're at right now. We have 10% baseline tariffs depending on the country, and then most actually fall into above that baseline between 10 and 30%. We celebrated Liberation Day a month ago now? It's been time's flying. And we had our president come out with a big poster board, a bunch of countries and a bunch of numbers. And then it turns out the next day everything changed. So we went from 125% tariffs against China, now down to 30%. That's a good thing for one of our major trading partners. And then speaking of major trading partners, the local partners that we have, Canada and Mexico, we're being a little bit nicer to them with exemptions, with agreements that we have, especially with auto. And then Charlie, at the bottom here, we have some product specific tariffs that are already outdated from the time we created this to now. So tell me about this 50% number we're seeing here.
Yeah, there was a press release issued that we're going from 25 to 50% tariff on aluminum, steel, and non-U.S. auto. Oh, no, excuse me, just on aluminum, steel, not non-U.S. automobiles. Are still at 25%. So we had a big bump up there. I don't know if it ever gotten written in stone or at least a piece of paper, but that's what we were told was happening 2 days ago.
It was written in a tweet.
The written in a tweet, just like a law.
Yes, exactly. So now we're here to tariffs, and if the everything happens the way it is now, here we are with the amount of revenue that's going to be coming into the United States. So this is the big selling point of tariffs, right? We can see here we are in 25 at $100 billion in customs revenue, and that's looking to triple and quadruple over the next 10 years. So, Charlie, I'll just ask you directly, are tariffs a good thing, a bad thing, somewhere in the middle? I'll throw you a hardball.
I love it. It all it all depends on where you are in it. If you're an importer of goods and reselling them in the country, it's not good for your margins unless you increase your prices. I do think tariffs have a positive spot where you're protecting your country and your country's interest versus people that are tariffing you. And so in the beginning, when this all started, was they were going to do matching tariffs. So, for example, you can't sell a pickup truck into Japan from the United States because the tariffs are 100%, but we don't tariff trucks coming in from Japan. I say we just make them equal to whatever the country's tariffs are, and then it all goes away eventually because people don't want tariffs. So they are good, but they are bad, and they are good, but you need to utilize them strategically to protect your country.
Absolutely, and a great trade negotiation tools we've seen.
Yeah.
So here we have a bit of an example. What happens if we have a 25% tariff? work me through the idea of what a company might do if they had a tariff of 25% as we see here.
Yeah, Zach, if you think about this, a great example is Nike shoes. It's estimated that Nike high tops cost $10 when Nike imports them from
Mm.
China. And if there was let's just go with a 30% tariff, 25% tariff's fine. A 25% tariff on $10 is $2.50. And so when Nike sells those shoes for $100 to American consumer, they might just eat the $2.50. They might pass it along. Maybe the seller in China reduces their price a little bit, so it could actually get affected by a lot of different people. So maybe that shoe only costs you $1 more.
Hmm.
So it can be definitely spread out and broken down in different ways. So you have to remember we're starting with the value it comes in, not the value it's being sold to the U.S. consumer. Which remember when something gets bought by Walmart or the supplier to Walmart, they are doubling the price, if not tripling the price, before you as a consumer buy it. So it's not as bad as it sounds. It does sound terrible, but that's a good example.
I think that's an excellent point. A $25 tariff on $100 is much different than a $250 tariff
Yeah.
on $10. So it's a really good point. And then we can look at the trend of this is really a look back more than a look forward, but I think we can surmise what might happen moving forward. So we can see back in 2018 here, we had the first round of tariffs on China in 2018 from our now current president. And this green line, I guess it's gray, green, one of the two, we can see after those tariffs were implemented, the amount of trade that happened with China went down precipitously, right? We bucked the
hmm
trend, moved the other direction. Do you think that this is going to continue to that extent now with China? Are we going to really become less reliant, or was this more of an exaggeration in the past, do you think?
Yeah, I think that the is going to continue to come down. Unfortunately, I do think a chunk of it may be that things get imported to Mexico or other places, then into the U.S. But I also hear that people are buying less things when I talk to people. So
Hmm.
I do think we have to get a trade at one point because we're definitely such an imbalance over long term that won't be good for us.
Yep, absolutely. And before we move on to our next topic, just a takeaway here. We want to drop a few takeaways strategically throughout the presentation. And one here is just being careful. If you're lending to businesses, be aware of who you are lending to. If they have an over reliance on China, I mean, a lot of companies may have that. Just be careful. Ask the questions of, do they have pricing power? Are we taking appropriate risk based on the unknowns, the uncertainties of tariffs coming down the pike? All right, that leads us to our next topic. One of the key metrics that the Federal Reserve is looking at when they're deciding what to do with interest rates. So, overall inflation, this trend's looking pretty good to me, Charlie. What are you thinking about this bar chart here?
Yeah, I see inflation coming down pretty quickly in a lot of different places. And, the Fed was cutting rates when they were back up at almost 3%. And now we're at 2.4 and 2.3. And people wonder why the Fed might cut rates. It's such a great conversation. But to
Yeah.
get a little more detailed, the next couple slides, we can quickly go through a couple of these here. This is one that was interesting to me here. Uh, I mean, energy. That just shocks me, Zach. I mean,
Yeah.
look at the old fixed utilities with a lot of ongoing people expenses are the only thing that are higher. But you look at gas prices down substantially, fuel oil. It's really positive for the consumer here.
Yeah, we often say that, anything that has inflation connected to it is really tied to gas, energy costs in general, because it has to get on a truck, an airplane, a boat, and cross the country or the ocean. So energy costs coming down is really good overall for inflationary trends.
Yeah,
Yeah.
absolutely.
I did want to ask though about this food away from home, this bottom orange number here. We were talking the other day. It just seems like when you're going out, at least from my experience, there's so many people still in restaurants spending money, ordering Uber Eats, so their $25 meal turns into $47. Any idea why this is happening? Are people just reluctant to change their spending habits?
I think inherently people can be lazy, and you're used to just clicking the button, Uber Eats delivering it instead of even walking or taking a car or a bike ride up to the store.
Hmm.
And I do see restaurants full. I still think it's very interesting.
Yep.
Um, yeah.
Yeah, here's another look at a few different metrics of inflation. Healthcare is all over the place, and we know that for financial institutions, this is one of your greatest non-interest expenses is healthcare. We can see it's a little bit it's basically around where overall inflation is, but very volatile throughout the years. And when we look at college tuition and fees, holy cow, this is just it's cheap, it's free. College is free.
Yeah. Well, number of kids, got to remember supply and demand. There are less and less kids. We're going to see a massive change to the number of kids in pre-K and kindergarten, grade schools. It's already happening, and soon's going to colleges. And colleges, they're getting the pain because people are actually not going because it's too expensive, also. So it's
Hmm.
going to be tough. We're going to see a big change at higher education here in the next few years.
Yeah, maybe we'll get that shift into the trades that we've been wanting for so long in our economy. That could be a great thing.
Yep.
Any notation on the airline ticket prices here? What a spike we had, and now we've really come back down. Maybe a good time to travel.
Well, but remember that's just your. This is the price. It went up. Average airline ticket prices went up 30% last year, which I saw when buying tickets. And they're not coming down. They're just not increasing or coming down, but they're still up 30%. So it's not any cheaper to fly today. It's more expensive and continues to be more expensive and until less people start flying. So
Hmm.
to me, this is all very interesting. It's when demand goes away, such as colleges and schools, prices will come down. Also, we had a question come in, could gas be coming down and will it stimulate the economy? And absolutely, as gas prices come down, it will stimulate the economy. People will drive, people will do more things, they'll have more money in their pockets to spend. So that is definitely a positive that's happening right now.
Yep. And one takeaway before we move on to the next thing is, if spending practices continue to be elevated, if people are going out to eat, maybe they shouldn't. We are seeing trends of unsecured lines of credit going up. We really need to be careful about that. We'll get into that a little bit later. But delinquencies and balances both rising, something to keep an eye out for. All right, here's our gas prices. There we go. So goes energy, so goes gas. As you mentioned, this is a great thing to stimulate the economy. I love to see it. Before we move on, just you mentioned a leadership meeting that you attended for young leaders. You asked them a question.
Yep.
How many of you, as we're on the topic of inflation, how many of you are changing your spending patterns? You told me basically the whole group
Yeah.
raised their hands.
About 130 people at this event, and they all said they're actually spending less.
Hmm.
I also asked them who drove an EV, and not a single person raised their hand, also, which was interesting to me. Um, there's gas prices are going to come back down. And if you look at this, there's some political timing of this. Democrats in office tend to want to make gas more expensive to push an EV mandate, and
Hmm.
Republicans in office want to get more oil pumping. So you do see some price volatility here, but I do think gas prices are going to continue to come down closer to $2, 2.50 a gallon on average.
Once sub $1, like when I graduated high school, that was a year, 99 cents in 2000. Yeah, so now let's
Well,
move on to our next topic of employment. This is the other major mandate of the Federal Reserve, right? They want to make sure that our inflation's in check, but also that we have full employment, stable employment. Um, we're going to get into one of the things to note is AI, and AI has been very disruptive. This is a good and bad, but it can have a tendency to increase unemployment where some jobs are moving more towards automation. So let's take a look at a few trends here. The national unemployment rate at 4.2%, we can see what a spike we had up here in 2020, came down quite a bit. If you look at the last 40 years, the average unemployment rate is closer to 6%. So it seems like we're doing pretty good just looking at this chart. When we zoom in towards the bottom here, we can see more of an uptrend. Is this a concern to you, Charlie? I think we're okay at these levels. A spike is what I would be concerned about. What are your thoughts here?
so I do think if you look at the overall the big picture trend, as you look at the top there, you'll see that we go down to low levels. We have an economic downturn, recession. We got to think we're not going to go happen what happened in 2008. It's not going to happen again for
Sure.
long. It's once in a lifetime. So, but I do think, look, we're at low levels, and we're most likely going to continue to trend up to a little bit above average or go back to average. It's just it's the normal trend and process.
Awesome. All right. Well, this is another look at total unemployed and also people that are just looking for more work than they currently have
Yeah.
available because of economic reasons. I see a similar trend here. I don't know if there's much more to say about this.
I think that here just to highlight. if anyone says to you, gosh, we're going to have a slowdown, people immediately think of 2008, 9, 10, and the Great Recession, financial recession. If we have a slowdown, it's going to be nothing like that. So I just wanted this is the difference of where we were and where we went to versus where we are today are so vastly different. Just that's it, real simple.
Yep. And a key takeaway with unemployment is, there's not a greater corollary than unemployment with charge-offs. So we're not seeing that massive spike. Wouldn't expect charge-offs to spike along with it because if the spike doesn't happen, it won't be there. But it's definitely, at least in my opinion, not a great time to be widening credit standards to chase loans, right? We want to be careful, even though we don't expect a major move here. Just be careful. We are trending up on the short term. All right, let's get into another fun topic. We are now at housing. We're going to talk about rent
Woohoo.
prices. Yeah, woohoo. A lot of things happening, really interesting trends. So this first trend, we can see a couple different lines, but I want to point out the average sale price of houses sold in the US, this blue line right here. We are very stagnant, and the median sale price for homes is stagnant, still very elevated from 2020 levels. But are we finally at a top with prices?
I mean, you're going so deep in this chart, basically just says house prices are really high to me. But um, I do think when you're starting to see right now, I call it when I look at a map and I say it's red and I hate the color red, that's just because Zillow has a bunch of little dots where the houses are for sale, and you're starting to see a number of markets where there's more sellers than buyers. Definitely, it has changed very quickly. And so I do think we're at a top for a period of time.
Mhm. Yeah, a few more charts to illustrate that we'll go through quickly. This is just showing the new home sales and existing home sales pretty stagnant over the last couple of years. So
I
that,
think one thing,
yeah,
Zach, I'm sorry to interrupt you. Is
no
one thing I
worries.
think from here is really important. The red line is new home sales. The blue line is used home sales or existing home sales.
Hmm.
You're correct, very stagnant, but just something to realize we're below levels that we were after the great housing debacle of 2008. You have 2010 there, we were, effectively at the same level or above. So there are more willing participants buying and selling houses back in the financial crisis than there are today. It's hard to get people out of their house when they have a 3% or 2.75% 30-year fixed rate mortgage. That's the problem we have. People can't move.
Yeah, if you ask anybody, I'm out at a outing or a conference and I'm talking to people and say, "Hey, your house is worth so much more than it was before. Are you thinking about selling?" You almost always hear the same answer. Then what?
Yeah.
Right? I've got a 3% mortgage. What am I going to do? I'm going to trade down and my mortgage payment's going to stay the same. Doesn't make much sense. Taking a look at new one family homes for sale.
Yeah, this is one I threw in here, a little new one I really like, and it's basically showing that we're almost at the same level of brand new unsold homes, the same level we were in 2006. So this is a disconcerting chart for home values because they're at such high values and we're starting to see new homes not selling.
Hmm,
So this could be one of those signs of a topping of the housing market.
here we go. I heard my word. Top. Over there.
Yep.
So now we have a growing gap between those house prices that, as you said, the prices are up, right? You can look at 2020, we've gone so far above, but the income, household income has not kept pace with that. What do you think that the impact is here? Just again, well, this is more on the buy side. It makes it challenging to buy, right?
Yeah, very unaffordable at these prices. And I think people had to buy houses. And when there's a limited supply and people have to buy, such as you're moving into a new market, what ends up happening is you bump prices way up. But when the typical consumer shows up that's only had a 40% raise since 2000, buying a house that's 200% more expensive just doesn't work. So eventually that should push prices down a little bit.
Yep, need lower rates or lower prices or both. And
Yep.
then here are those that are choosing or maybe not choosing. They're in a rental situation. And we saw a dramatic impact, a lift up from $1,300 for rent, now up to $1,600. So just a very challenging spot to be in, compared to buying a home. Speaking of buying a home, it just keeps going up. People are staying in their house for all the reasons that we said before. It's hard to leave that low rate. Just a quick takeaway here is that, keeping an eye and underwriting LTV and DTI incredibly important.
Yeah, it is. And Zach, as we also get into autos here, to remember student loans are now being recorded as past due. And it's some big
Hmm.
numbers, like 40% of them are past due, and it's really hitting credit scores. So keep a close eye on student loans and credit scores.
Yep, very good. Now we'll get into autos. We can see auto sales, so recovered quite a bit, doing better. We're not doing too bad here. This chart seems reasonably healthy to me.
Yeah.
And oh yeah,
No,
sorry,
say it. No,
just to
it's fine.
jump in really quick,
Yeah.
this is a tariff spike, perhaps front running tariffs.
Yeah. It was. You can see that at the far right there,
Yeah.
that there's a spot there, tariffs popped up and now we're back down. So, but it still looks really good. It doesn't look like we're in any recessionary activity when you look at car sales.
Yep. Good for, actually, this is also an indication this is good for lending, right? Auto values have really come down over the last couple of years, but we've been in a stable position, which is a great place for lending. But again, we're not recommending widening credit standards. We want to make sure that our pricing makes sense for the risk, having a lot of conversations with where is your risk? Is it an indirect? Is it in the lower credit tier? Make sure that you're being compensated correctly. But at least recently, values are maintaining. Anything else to add on this one, Charlie?
Nope, they're high because new car costs are super high and cost of debt super high. So people don't want to get rid of their old cars.
Hmm.
Yeah.
Yep. All right, we'll get into some of the fun stuff here into the stock market. Let's take a look at a chart. So we have recently gone into all-time highs, going back to the beginning of the year. We can see this double top here, and tariff predictions came through. We had a fall, and then they actually happened. They fell, and then, as we mentioned before, a new tweet came out, and we're off to the races. So we are potentially near full value right now. Are we going to make all-time highs again? Are we going to have more volatility? I say, why choose? Probably going to have both.
Probably both. You're right. There's going to be a lot of volatility no matter what right now. There's so many different opinions on what's happening in this world and viewpoints. But man, are the values high. Wow.
Yep. And different sectors are leading this. Technologies at all-time highs. Industrials is all over above all-time highs, and communications. A few laggers too. Healthcare not doing so well. A little bit of recovery this month, but we are seeing some lead the way and some kind of take a back seat. The Nasdaq not much different. Here's our technology look, and it's a good opportunity thinking of a takeaway with this. What do we do with the stock market? It's not a traditional investment in standard financial institutions portfolios, but depending on the strength of your capital and your earning stability, it can make a lot of sense to have this asset class as a hedge against the rest of your balance sheet, which is primarily interest rate driven. So if your credit union, employee benefit accounts can help, charitable donation accounts. If you're a bank holding company can hold assets that the bank cannot. And if you're either or, having a foundation is a great way to participate in a potential long-term growth as you build assets to impact your community. So a lot of great potential here if you're willing to endure some volatility. All right, FOMC. We talk about this quite a bit, Charlie. Let's look at what the Fed is being predicted by the market.
Such an interesting spot here, Zach. I think
Yeah.
you and I are aligned here with what the market's showing. Um, the Fed looking is that there's an expectation of July going down 25 basis points. The June meeting is a week from tomorrow, I believe, if I'm doing my math correct. I think there's a chance they cut rates tomorrow, although I don't think Jerome Powell is very happy with the words that he's been called.
Hmm.
Might delay him a little bit, but we are seeing inflation down. We are seeing unemployment bumping up. We're seeing those basic things that suggest that we're getting into a softening economy. But the Fed funds predictions here, which is just the betting in the market, will show you that there's not a lot of feeling there's massive movement. This is saying, hey, we're going to be around 325, 350 the end of next year. So that's maybe 100 basis point cut between now and the end of 26. So not a lot of movement. It's usually correct the direction, but the scope is not always very correct in the predictions.
Yes, the wind is blowing down, and I feel for Jerome because what do we call him, JP? Jerome?
I like Jerry, but yeah, whatever.
Jerry, we like Jerry. I feel for Jerry because he always talks about, hey, we're data dependent, and then there's a lot of political pressure. If he is going to move rates, I think he needs to come down and say the data's there, right? This is not a political move. This is data driven. We're going to get a little bit ahead of it because the Fed has been behind the curve, no pun intended, for the last couple cycles, right? It's time to be a little proactive, but not crazy. And speaking of that, we can see the Fed funds, the different cycles. What are we thinking? Historically, we've gone to zero. We don't go to zero again, do we?
That's like saying historically when you're like 10 years old is what that just said there. No, listen, we should get back to more of a normalized rate would be the expectation. Somewhere I would think we get down to three, 2.5 would be a normal. Remember the Fed wants a 2% rate of inflation. So the fact that they're paying 4.5% on deposits is they're actually creating inflation higher than 2%. So they really want to be somewhere around 2% with the Fed funds rate. And back in 2018, 19, that's what they're trying to do is normalize. That's what they were doing before the little pandemic thing showed up. But the Fed has this history, as you said, they ratchet rates down too far, they overstimulate the economy, the rates then get ratcheted up to break something, and then they
Mm.
break something really bad and we come down. They have that history, and I don't see why I think there's more of a chance of them having a problem and rates coming down fairly significantly than staying local. But all the futures, everything's predicting that somehow this is all going to stay relatively calm, maybe go down 100 basis points.
And what a beautiful yield curve that would make.
Oh gosh, Craig would be so happy. He'd be like smiling ear to ear.
Somewhere in this building, I think he's fist pumping.
Yep, yep,
All right, we've got economic indicators that we want to take a look at as well. And, the yield curve inversion is quite interesting. We can see, take a look back at the 2 to 10 yield curve inversion, 564 days that we came out of. I forget when we broke that. We have a date. Hey, we have a date. 9/6/2024. So not
yep.
too long ago did we break this record event.
Zach, one of the things that ties in really well with this slide, plus our previous slide, and a takeaway I wanted to add there, when you look at the volatility in the Fed funds rate, you look at where we are with the change of the shape of the yield curve, basically meaning that we're a positive slope yield curve now. What this should tell us is that most likely rates are coming down, and we should be, and a takeaway should be prepared for lower interest rates. Be prepared for minus 100, minus 200 basis points in your ALM reporting. Make sure your investment portfolio is structured correctly to handle that. And we'll talk more about that later, but a really important takeaway.
Absolutely. Yep. Here's another picture of a similar thing. Won't need to spend too long on here, but the real takeaway here is that the dotted line, the 10-year treasury, it does move with the Fed rate, but it's very delayed. So sometimes people want the Fed to move mortgage rates. Well, it doesn't work like that, right? They control the short end of the curve. They can, through quantitative easing, control the long end. But really, it's the short-term interest rates that we can see with the red line, the Fed rate, the blue line. They tend to move in tandem. So if the Fed rate comes down, we would expect to see shorter term rates come down. And to your point, being prepared for lower rates, don't spend too much time in cash if this is where we're headed. And history would say we're heading lower.
Yep.
All right, GDP. So the Fed projection now is around 1.4% 2025, a heck of a lot better than negative 20 basis points. I see a very stable line here, no whippiness recently since 2020. Any comments here on GDP?
Yeah, this is really an interesting spot. We've had the first two reads are current reads negative 20 basis points. We'll get the final tomorrow, I believe, if I'm correct. And so we will see a negative GDP print. Now, the first quarter is always more volatile and tends to be lower than the second, third, and fourth quarter. So I don't want to lose all faith in the world, but I do think this adds to the comments I receive from a lot of people about slowing purchases and the economy slowing just a little bit. So I do think this is maybe a little bit of a canary in the coal mine that things are just slowing down a little bit.
Hmm. Yeah, ISM manufacturing would agree with that. Business orders below 50, that's a contraction within businesses, right? So we've been here for a couple of years. Nothing's fallen off the rails, or things are just kind of slowing down a little bit. And we can see the real correlation with interest rates as we had interest rates rising in 22. Now we're very stable. Any other comments here?
Yeah, so ISM manufacturing below 50 means things are contracting.
Yep.
And so it doesn't mean the US economy is contracting, it means manufacturing is contracting. And so we had a number of years through 23 and 24 with manufacturing was contracting. And that makes sense. More and more was being offshored, more and more work was being taken outside of the country. And we're also shifting from manufacturing to, software and technology and other types of things.
Mm.
And so here it's not the best news for manufacturing. We hope that onboarding or onshoring of manufacturing that appears to be taking place will bump this up a little bit, but this is traditionally a indication of a slowing economic activity.
Yeah, maybe we'll get to 50 through the tariffs. We'll see.
Yeah, we'll see.
We'll see. Here's hoping. All right, let's get into some other topics. Credit card delinquency. I don't love this short-term trend. It does say that we're projected to grow, but more slowly. Um, we're just hearing a lot of the concerns on the balance sheet are on the unsecured lines of credit, tying back to what we talked about before with spending habits. As the government is overspending, so is the consumer. Um, any real concerns that you have on this, Charlie, or just be careful with underwriting?
Yeah, so I think Zach, and we're going to hit government spending later, which I feel rude to the American consumer that you compared them to the U.S. government, which is just horrendous. But this does show though that the consumer is starting to run into some pain points, and it really comes down to 7% car loans and 7% home equities aren't cheap, and the consumer is not used to that, and with that income standpoint. So this does show, and we hear it with Target's earnings calls and other big box retailers about the consumer being a little tapped out. And so I think this is highlighting that, and we'll probably continue to see delinquency edge up. Remember, we're at now 2000, almost at 2008 levels, just to be
Hmm.
comparative here. So we need to remember that kind of the economic peril we were in back then.
Yep. All right, so be careful. Now, this looks like the throw caution to the wind.
Yeah,
Commercial loan.
exactly.
Where'd the delinquency go? I mean, this is just a beautiful chart.
This is a beautiful chart. This really highlights the strength of the business community compared to the individuals. And what I do also think, COVID was good in some ways and bad in some ways. Everyone has different opinions and components, but the amount of money that went out with all the government programs to businesses was astronomical, from the PPP loans to the ERC credits, even more so the ERC credits.
Hmm.
And a lot of businesses got a lot of money, which is enabling them to keep on top of stuff.
Yep. So a good environment to be lending into, but again, not to go crazy. All right, I'm having trouble reading this, Charlie. Does this say Trump and Musk? Trump and Elon?
Yeah,
USA and Doge. What a topic.
it is unbelievable.
Let's look at what's happening here. So, the purpose of Doge, the Department of Government Efficiency, is what are we going to do with this debt and our spending? This looks fine.
Yeah. Uh,
Very unsustainable.
yeah. I think it's I get blindsided by the political nature of this world, and by nature we're non-political here. We pretty much hate all politicians because none of them can balance the budget. But the comments about the big beautiful bill that's coming out will add true 2 trillion of debt. If you look at Biden's last year, it was like 4 trillion of debt.
Hmm,
So frankly, 2 trillion is an improvement. I'd prefer it goes to zero. We're going to talk about mandatory spending, but we're at a point here which is just absolutely shocking to think pre-pandemic we've gone from 24 trillion to 36 trillion of debt. That's 50% increase the debt of the country in just 20 years. So
absolutely.
yeah,
Wild. And if we break it down a little bit, here's what you were talking about with mandatory spending. This is, what is it, Social Security, things like that, right? Things the
yep.
government cannot, well, they could, I guess, theoretically, but they should not stop this type of spending. The green, though, why is that growing? That seems to very counterintuitive
Yeah.
to me. The discretionary spending.
Yeah, so I think, Zach, I'm going to answer that in a long way. I think what
Yeah.
we have here is a spending problem and not a revenue problem. And that's the first thing that we need to address as a country. Raising taxes on people above 40% to 50 creates a disincentive to work. And we're already at 50%, especially when you add in state taxes on top of federal taxes. Don't worry about even talk about gasoline taxes or property taxes. Taxes have gotten to a point where it's extremely debilitating. Middle class is getting taxed to death. What we see here, though, is the black line, the revenue line continues to go up very quickly. We're talking about going from 4 trillion to 6 trillion, 7 trillion here, almost 8 in just, 20 years. So with that, the spending, the mandatory spending, which is Medicare, Medicaid, Social Security, that's gone through the roof. The yellow one at the bottom is a result of our bad activity, which is our net interest payments. Interest payments are getting it to be $1 trillion. They were zero forever. And now, on top of that, the green bar is growing, which is the discretionary spending. And those are the pet projects, the programs that can get eliminated. So there's a lot of things that can get eliminated. Mandatory spending needs to get reduced. We have to have a very serious conversation about Medicare, Medicaid, and Social Security. there's not enough people putting in to take out, and that's a tough one. No one wants to touch that. But across the board, we do need to reduce spending, and this is why I think anyone that's against Doge doesn't understand the debt problem we have. Now, you may be against Doge for the way they talk about stuff and the way they act, and maybe how they come out with a chainsaw screaming. Those are all things that might bother people. But in theory, to get rid of government waste, we should all be absolutely fired up behind it.
I totally agree. I think people are upset with sometimes the ones that are with the methodology, but not the spirit of it. And going back to this yellow part really quick, the interest payments, 2 meetings ago with the Fed, they decided to reduce their treasury roll off a little bit, indicating that quantitative easing, I mean, it's a one step in that direction. One way to control interest payments is to keep rates down so the US government's refinancing rates stay under control. We may see more of that, not necessarily a prediction, but I wouldn't put it off the table for the Fed to continue in that direction.
Uh, this is one reason why the Fed should be cutting interest rates. They should be trying to get lower rates because we're not going to be able to afford the debt payments. So,
100%.
yeah.
That's right. All right, let's get in some state-specific issues as we get close to the end of the presentation here.
Yeah.
And we can look at our friends in Michigan. Unemployment benefits are up. No more tip wages, onshoring of jobs. What are we talking about with the onshoring of jobs here?
Yeah, we're looking at there might be some onshoring of jobs in the automotive space from Canada, from Mexico, from Japan and China. We're seeing potentially some growth in plants. We'll see if that takes place. At the same spot, we're seeing offshoring of technology jobs, so we're losing some of the higher paid jobs and bring some lower paid jobs. But we're also seeing some big increases of homes for sale right now. Definitely seeing a slowing market, becoming a buyer's market, not a seller's market right now.
And then we go south to all of our snowbird friends and we can see Florida. This Florida is interesting along with Texas because, especially when it comes to real estate, there was such an influx after 2020, people moving in, trying to escape taxes, whatever the motivation was. And there was a lack of supply. Now what we're hearing, especially from some boots on the ground, we have some folks down there, right? And
Yep.
we're hearing that was there an overproduction of homes? There could be a little bit of a bullwhip effect here. What do you think about that?
It's interesting, Zach. I don't see as much as a overproduction of homes. What I see is, people are dying to get out of Florida, right? That's, you move there and you live there, and end of life could be is in Florida for a lot of people. And what happens though is when people can't move from Michigan or other cold states to Florida, because if you think about this, you have a 3% mortgage on a house, even if you're going to go buy the exact same house in Florida and get the exact same mortgage, your cost of ownership has doubled, going from a 3 to a 7% mortgage.
Hmm.
So a lot of people can't afford to move and stay at the same level of house that they're in. And then there's a little issue with insurance policies right now. Insurance costs are up just a little bit. And so all of that being said, there's more sellers than buyers in Florida right now. We're seeing a fairly significant resetting of property values.
Hmm. Yeah, California and Illinois have the opposite effect. A lot of people moving out of these high tax states. We love you, our friends in California and Illinois, but for sale properties rising there, but maybe for a different reason, more the taxing and are you still hearing about migration out of these states here?
Yeah, yes, I think is the clearest way to put it. We are seeing definitely continued out migration. There comes a spot, if you think about this, 20 years ago, 30 years ago, while the internet was young, people really didn't pay attention to taxation levels and compared to other states. And when you start looking, hey, wait, if I move 10 miles north to this other state, or if you're in Detroit, if I move 50 miles south to Toledo, what does that do to Ohio? What does that do to my tax bill? And people are getting smarter and looking at that, and we're seeing that take place. So I do think there's going to be continued trouble. Obviously, a bunch of unrest right now in California. We hope all that gets sorted out quickly.
Hmm.
But that definitely also adds to that migration. If people don't feel safe, they tend to go different places. So tough spot. We're going to continue to see that. They're not going away. Don't count Illinois and California out. But it's also interesting as you look at the economic dynamics. And Zach, I really appreciate you putting these states in here because a lot of times we talk about the big picture, and the big picture is true, but also local issues can greatly modify local economic activity too.
Sometimes local government is much more impactful than national government, right? And the
Yeah.
different tax policies. Texas is very similar to Florida. Anything else to highlight with the our friends down in the Longhorn State?
It's been a great influx, a lot of technology, a lot of things happening there. I think it got well ahead of itself, so they're seeing maybe some overpopulation growth and from that large in migration, but very tax friendly. And again, we're seeing companies continue to look to migrate too to help save on corporate taxes. So interesting spot today.
A lot of outflow from California into Texas.
Yes.
All right, now we get to the point where everyone's so excited, right? What do we think? Let's bring out the crystal ball and predict where things might go. So, future economic projections. So, here are some business thoughts. Charlie, we're seeing inflation slow. That's an obvious thing that we're seeing. Consumers slowing down due to debt. What jumps out at you on the screen that you really want to highlight here?
I think thinking about going back to my financial institution after this as a listener, um, I'm concerned about the consumer. We're seeing loan volumes down. We're flat at best for a lot of institutions right now. I add on top of that the student loan situation that's resulting in actually a pretty decent hit of credit scores. And as unemployment edges up a little bit too. So all these things are just chipping away at loan demand. So I would make sure that you look at your budget and maybe reduce your loan demand expectations for the year. To me, that's one of the biggest components. Um, as I look at the uncertainty in the world too, that it's not a very certain world. I know for certain I'm going to have dinner tonight. There's a couple things I can bet on, but the tweets, the wars, not even to compare a tweet and a war, but there's just so many things going on geopolitically, which makes it very, very difficult. And then here in the U.S., we have to make changes. And I've said this for years, and I'm going to continue to say it. We can't keep going as we are, so they have to make cuts. That's why the Doge is good in some ways. The good ways that they're making cuts and reducing spending. A lot of that spending doesn't come in until October, November, because people are getting paid through 9/30. But we need to make sure we get some of that. Also, Zach, I think deposit growth. What are you seeing from you're talking with your clients right now in the deposit growth space?
Yeah, deposit growth seems to be a lot stronger than loan growth. I did a recent poll with our advisors here at McQueen, and I said, show your hand if you are hearing a ton of loan demand. And it's like, well, I've got this one institution I talked to, this other institution for this very particular reason. But deposit growth seems to be a little bit more stable, even to the point where maybe that holding on to that cash. Let's be careful again, as we mentioned earlier. Cash is great, liquidity is awesome, but having that well-structured portfolio, there's a strategic takeaway. Don't hoard too much cash because in times of slowdown, historically deposits have been very strong.
Yeah, as we go to the next page, I've got some comments on
Sure.
portfolio duration and things I want to talk about. So, um, but go ahead and what do you think housing? Before I get to that, I'm going to close on my comment on the portfolio there. But from a housing standpoint, how are you feeling?
I'm just glad that I mean this is a bad thing to say, but I bought a house when rates before rates went up. I'm very happy I did that.
Yeah,
If I were to buy the same house today, it would be, so much more expensive. I think I would have passed on this home, and it was a great home for my family. So I feel for people that are in the market right now, we really need to see lower rates in order to make things affordable, or supply just needs to increase. But it is heartening to see that at least prices are no longer skyrocketing and we may be transitioning into a buyer's market. So I do like to see that. Yeah,
yeah. I do think it's going to get better. More and more stuff coming up for sale, and if you look at a lot of towns in Zillow, you'll see a lot of red dots right now. Prices are slowly adjusting and continue.
maybe it's time to re-download that app.
Yep. Car prices, I expect to say high because it's so expensive to buy a new car. That's something that really jumps out to me. And, I do think the jobs and technology, there's not a day that's going to go by that we're not going to talk about this. There's definitely, AI is taking a toll on a lot of businesses where we're seeing layoffs and artificial intelligence is able to replace jobs. So that'll be interesting to watch how that all unfolds here for the next couple of years. But that will probably push the unemployment rate up.
Hmm, absolutely. Are we ready for the interest rate projections?
We are, but one thing as we get there, going back to our comment about you said the investment portfolio and cash, it's really important that we're prepared for lower interest rates. And that being said, is you don't want to have too much cash on your on hand. You want to have a good ladder. You want that good ladder not to be comprised of callable securities. And if you have mortgage-backed securities, you want to limit it to good mortgage-backed securities, not really long, volatile mortgage-backed securities. Reason being is traditionally One of the toughest spots for a financial institution is when interest rates decline. And the reason being is our deposits floor out very quickly, and then we have a bigger reduction in our yield on our assets. And so we want to do is protect ourselves for that. So reducing cash or having cash at the appropriate level, and then buying a ladder. We were asked earlier in the presentation, what kind of ladder do we recommend duration wise? Well, it depends on your individual institution. We have some clients that if buying 5, 6, 7 year bonds is correct, and we have others that buying 2, 3 year bonds is correct. The ladder has to make sure that your earnings do well in a rising rate environment or a falling rate environment. I want to be a little more sensitive to a falling rate environment today than rising, but I still, I don't want to make a one bet. And so you manage that portfolio to do well. So really, the goal is to be prepared for lower interest rates. And then with that, speaking of lower interest rates, Zach, what a great lead in.
Hey, what's going to happen? Let's take a look. This is guaranteed to happen, is what we're going to go over here.
Yep.
All right, so we have quite a few rates that we're going to be looking at. We have the Fed rate at the top, currently sitting at 450. May or may not see a cut. We're not necessarily expecting it, but we're thinking that we're going to get a little bit of reprieve from the Fed rate coming down. Not quite as much as the market's currently predicting, but a few cuts do make sense, which would be dropping SOFR prime rate. There's some connections there, and the 2 year treasury, maybe a little more stability on that short end of the curve, which would be awesome from a yield curve perspective. If the Fed rate comes down, the short end remains a little bit more anchored. We did see the prior chart. If the Fed rate gets too low, that it will bring it down, the short end of the yield curve. But I would love if these predictions come true because it's just going to make profitability that much easier as financial institutions lower their cost and have a ladder to invest longer out into. What jumps out with you this projections here, Charlie?
It's interesting, Zach. I'm excited. We see the Fed funds rate coming down. We don't all agree with it, by the way. We all agree it's coming down, but we have many people here that think it's going to start coming back up in September or December of 2026, depends on the timing. A lot of it is that inflation concern. We talked about, does inflation stick? Well, when you go out and buy something and inflation has caused it to go up, it's that one time increase that hits inflation. If things don't change again, there's not inflation. But if I buy something else, it's substitution and potentially deflation. It's
Right.
really going to hinge here on how the consumer acts and what happens to tariffs. So this is, I think, a very good prediction, and I do think and very logical. We could see things just come down a little bit, but if inflation gets persistent, they're going to not come down much more and maybe reverse themselves. So I think it's a good midpoint projections. I am excited though because a steeper yield curve. Going back to your
Hmm.
statements, that steeper yield curve really helps us with earnings. It's not going to help a lot with mortgage rates, unfortunately, but that's something we'll see if the Fed starts to do open market activities and buying bonds to try to drive down Treasury rates to help the market, but help the housing market. But that's the one thing that Trump is pushing really hard on Jerome Powell, Chairman Powell, is that he wants to see him cut rates to spur the housing market. And we'll see what happens. That's definitely obviously a strained relationship. Um, GDP, that's another one surprising. We're negative. It's projected to be pretty low. And that's that would cause potentially a slowing of the economy also, or show the slowing of the economy also, excuse me.
Yeah, and I just want to mention, along the line of the takeaways, what to do to prepare. We spend a lot of time talking about assets, almost take for granted the liability side, but what the conversations we're having, most people are staying relatively short with their liabilities, right? I don't hear a lot of 18-month, 24-month CD rates. Not that that's even that long, but most people are sticking around the year. If they're going to get aggressive, you get what you pay for. So if you're going to get aggressive, probably lean towards the shorter end, which will allow those liability costs to come down as rates fall. Another interesting thing that I'm hearing is that these money market rates, as CD rates fall, Charlie, are getting closer and closer to parity. Some people are going to start to choose that money market rate, and that can be a good and a bad thing, right? It can be a bad thing because all of a sudden your costs go up immediately if a bunch of people run into it, if your rate's too high. It can be a good thing, though, for the liquidity of the member or the customer, but it also for the institution as your ability to be more nimble with those rates and bring them down if rates fall can be even quicker than a short-term CD. So the liability side is a big key to potential success here as well. potential rates falling, success in that environment.
Yeah, no, I think that's a really good point. It's loan pricing and deposit pricing and terms and products are extremely important, and really having that conversation on how to price liabilities is really going to make a difference. You don't want to lock in long-term liability costs right now is really, I think, is a fair point to put there. I don't want to bet super short, but we want to balance that. Well, we've got some questions coming in, Zach, and want to get a couple of them out there and answer them. So perfect timing here. Um,
Perfect.
there's one that I'll answer is what's driving your 10-year Treasury projection. It does go up a little bit, and part of that is the shape of the yield curve, potential increased borrowing costs by the United States Treasury versus just because of supply and demand. We think that the continued, unless we get the spending habit under control, we're going to continue to see the market demand a higher yield out of U.S. Treasuries to pay for it. So that's what's pushing it up in that point. Uh, Zach, there's a great question here that came across is how similar of an impact on employment do you see the AI revolution having on employment versus what the robotic revolution has had?
Ooh, wow. It's funny because on the way in, getting ready for this webinar, I thought of a different analogy. Yeah, this is more of an indirect answer, but remember the Pony Express? Remember when we were kids? The Pony Express, that was an industry completely wiped away, right? So when technology changes dramatically, I think this could be bigger than that. I'm not a historian. I don't know exactly all the details of that time period, but AI is incredibly disruptive to any task that is input based. It's very data driven. Those jobs are really going to start changing dramatically, if not going away. And on a benefit of that is, as you're running your institution, I'm having a lot of conversations with executives where they're thinking, how can I elevate my people and reposition them because AI is doing a percentage of their job? How do we help them become more efficient so they don't become obsolete? So, here's an opportunity for people to elevate, but I think it's going to be incredibly disruptive. And I'm not even sure if we've seen the tip of the iceberg on this yet.
It's interesting, Zach. I really appreciate those comments. It's not just that numbers, data-driven people. Goldman Sachs the other day said it'll just take them a few hours to put together offering documents to take a company public or sell a company, because frankly, they've put in such a good AI system that has all their old deals. It just automatically writes the new deals, and they've gotten rid of floors of attorneys where now they just have high-end attorneys reviewing the work. So it is definitely interesting how it's going to shift employment. I think it's going to be fairly substantial. It's the hype. It's not to the full hype yet, but over time it'll catch up and get there. But that's one of the things here that makes me think that lower interest rates are going to be on the horizon because if we continue to see this chipping away and this chipping away of unemployment, that's going to cause the economy to slow and the Fed will result in reducing interest rates. And by the way, if I don't have a job, I'm not buying those $3 more expensive Nike shoes anyways. And so inflation rate comes down. So it becomes a circular pattern here. So
Hmm.
I'm a bit more on the side that we're going to see, again, not a recession. Let's not, don't go and hide under the stove in the corner or something, or under the table in the corner. I think we're going to see things just slow a little bit, not terribly. I'm still very bullish on the economy, bullish on the stock market, but we should see just a little bit of a slowdown of economic activity.
AI can be a great thing. Very disruptive, but a good thing.
Yep. So there was a question that came in, Zach. I think a really good one for you. Did I hear you say that credit unions can invest excess cash in equities such as index funds?
Yes. With specific provisions. So the NCUA specific to credit unions has carved out 25% of your net worth under the employee benefit pre-funding account provision. You can take that and you can put it in normally and permissible investments. That does not mean that the entire 25% of your net worth needs to go in ETFs or equity market, but you're able to. So really the starting point is taking a look at what your goals are, taking a look at your capital strength and your income earning stability and saying what percentage of this provision makes sense to go into these types of assets. We can obviously help with those conversations. And also charitable donation accounts, same thing, different purpose for the purpose of giving to charities. And then apart from the institution itself, you can have these type of portfolios in a foundation, which is a whole nother thing. We have webinars on it. It's one of my favorite topics. I won't get going on it, but happy to talk more about that later.
Yeah,
Does that answer that question, Charlie?
it does, Zach. Really well done, and that's something that I know that as you lead our alternative investment team, which manages all the BPA and CDA accounts, it's an exciting spot and really neat growth spot for us. So thank you, Zach, on that.
Oh,
Um,
Charlie, sorry. I see you're going to the next one. One
yep,
more thing. It's a non-correlated asset to interest rates, which is a big thing
right.
I love. All this talk about falling rates, let's diversify the portfolio. Another takeaway there.
Yeah, that's
Yeah,
a great spot to add there. Thank you, Zach.
sure.
We did get another question in. Do you think that a new Fed chair next year may cause rate cuts to happen more aggressively? It's a great question.
Hmm.
That's a lot of speculation on many levels. Uh, I do think, and this is easy to judge, my decisions in hindsight as it is to judge other people's decisions in hindsight. I think Mr. Powell was wrong with the transitory inflation. He was wrong with a lot of things. And I do think someone else is going to probably come in and say, I'd rather be wrong now to stimulate the economy versus slow the economy. And you remember, there's two ways to get out of debt. One is to go bankrupt, and two is to make more money and pay down your debt. So we do want economic prosperity in this country. We want a bigger GDP growth. We want huge GDP numbers. It makes our debt really small, but we also want low inflation. And that is hitting the nail on the head. Good economic growth, low inflation, that's where we want to be. And I hope the next Fed chair sees that a little differently than Mr. Powell does. It's a tough job. I tell you that's low on the list of jobs I want because no matter what you do, you're going to be judged in history and you with things you didn't know at the time. So I do think they will cut a little bit more. Aggressively is an interesting statement. I think aggressively means they're going to cut rates instead of maybe two times, might be four times or five times. So we're not talking 2, 3, 4% modification. Anything else you want to add there, Zach?
It depends how political the Fed gets. They're not supposed to be political, right? There's a lot of political pressure. So it depends on who's appointed. I would hope they wouldn't have too much, move too much on what the White House is saying, but it just depends on the person. And definitely there were mistakes that were made in the past that hopefully we learn from. A lot of waiting too long and then acting too quickly. We need a more moderate approach, I think, moving forward.
Yeah, I agree with that. So, well, I really want to thank you, Zach, as we flip to the last page here and appreciate the questions from everyone. Great to see everyone on the webinar here today. We appreciate the relationship we have with all of you and the continued support and utilization of McQueen Financial for your services at your institution. We're here to help and we appreciate all of you. So thank you very much. With that, Zach, thank you. Really appreciate you putting this webinar together and giving the presentation and for me to be here with you.
Thank you, Charlie. And thank you, everybody that joined, and really appreciate the questions.
And the next slide here, you'll see our next webinar coming up is on August 19th. It's Portfolio Power. It's going to
What a
be
name.
awesome. I know we're excited. We're going to spend a lot of time talking about investment portfolios, how to manage where we should be given the unique situation we are. The next presentation will be on August 19th at 2 to 3 p.m. Please reach out to your advisor or go to our website and sign up and have yourself and others join us and attend. And again, as I started in the beginning, our webinars are recorded. Please reach out to your MFA advisor and they'll happily share it with you. Or you can go to our YouTube channel where Zach and I are YouTube stars. So click on the like button below. Uh, all right, maybe not. But thank you very much, everyone. Have a wonderful day.
Thank you, everybody. Bye-bye.